Bienvenue retour and welcome to the world. When we started Macroeconomics chapter 9, sort of 3 videos ago, we said we need to change glasses to the bigger ones. Today we sort of even leave our country, go into the world, so we might need an even bigger. I found that one, but I'm not absolutely sure. No, I can't really read the things I want to show you, but whatever. That might be one possibility. It looked like holidays. It looked like going abroad, doing business abroad, whatever. And that's in fact what we talk about in this chapter. I find it interesting that the British authors of our book in fact take subchapter 11.1, the business problem, membership of the Eurozone. So should the UK be a member of the Eurozone? That might be a very British question from a European point of view, mainland Europe point of view. And the book is sixth edition of Begg and Ward from 2019, 2020. That was when the UK was a member of the EU. Since then, the Brexit was put into reality, and the questions might even be different. But on the other hand, they aren't. So let's keep this for a moment in mind. Membership in the Eurozone, so adopting the euro as a currency in Britain or in another country, whatever it might be. Then we go ahead and talk 2 chapters or 2-part chapters about Forex markets, foreign exchange markets, and the different regimes, the different types that we can look at here. Followed by 11.4, the balance of payment that has already been announced in chapter 10, that there will be more definition first of all, but we are also going to look at numbers. I'm going to show you some sources for figures about the balance of payment, which is an important part of measuring the situation of a country. Followed by a bit of policy, exchange rates and government policy, European Monetary Union. Again, a first view. We go deeper into the EMU, the European Monetary Union, in chapter 14. And then some business applications, including one term that we are going to mention. It's hedging. I'm sure many of you are aware that there is such a phenomenon. What is that? We are going to briefly have a look at this. So let's start and enjoy our chapter, first of all, about exchange rates. Having looked at the table of contents, learning outcomes are the things we already saw in the table of contents. Exchange rates and the 2 regimes, fixed and floating exchange rates, what does that mean and what do we learn from this? The performance and so on, and then the main accounts of the balance of payments, something we mentioned before, and then sort of, we could say, a bit of an outlook. Learning outcomes, evaluate the business opportunities and threats presented by the euro from a British perspective again. Understand hedging, trade balances with the Eurozone and so on. That are things that we might have a look at the end. And that brings our authors to the question, should the UK be a member of the euro? What are the implications of being in the Eurozone, of not being in the Eurozone? And that leads us to thinking about Forex markets. Provided with the definition, a Forex market is where different currencies are traded. Up to now, we only knew markets where there is a quantity of something real down here, the quantity of goods, the quantity of cheese or whatever we had of apples, we had in microeconomics, or a quantity of goods and services produced, the GDP. Something like this we always had on the horizontal line of our market diagram, and then on the vertical, a price. And here this is sort of very similar. It's the quantity of pounds, pound sterling, the British currency. And if we want to buy a pound sterling, because, for example, we want to spend a weekend in London, or we want to buy something in Britain, then there is an exchange rate. And this exchange rate is a price. How many euro do we have to pay per pound? And that's already sort of the first secret of a market. There is no secret. It's a market that works exactly as we are used to dealing with markets. And there can be exogenous changes. Here we see that at this equilibrium price, let's say of €1 per pound, there is a specific amount of pounds which are demanded. Now, there can be external changes, like a right shift. A right shift, which means demand for sterling increases. What might be the reason for an increase in demand for sterling? That is a question we can take with us to class. Think about specific goods, think about preferences, but perhaps also think about interest rates. What might leading interest rates in Britain versus the Eurozone lead to, and which situation, which constellation causes a possible right shift of this demand curve? Question mark. Our book shows us on slide 6 a comparison between the two. There might be from QD0, the right shift, to QD1, and that would lead to an appreciation of the pound. If there is more demand, then the pound appreciates, whereas on the other hand, if the demand for pound falls, then the exchange rate depreciates. Quite as we are used to from microeconomics or from any analyses of markets. In our book, we find the example of Forex rates for the euro, this time the viewpoint from the euro, from 2019. So here we have relatively new, at least the date when I recorded that video, which was 16 October 2025. And you can compare the different Forex rates, the different exchange rates for the different currencies against the euro. You can see that there were a bit of appreciation, but sometimes for some currencies also a strong depreciation. And that might as well be something we look at and we compare. We can also compare this figure that is now here with the figure at the time when you watch the video or when we talk about it in class. This is already sort of the theory. There is no new theory about exchange rates of Forex markets because there are markets. The only thing that we sort of have to learn, have to consider is that what is traded is not something real, but it's a currency. Now, what to do sort of with Forex markets from point of view of different nations, of different currencies? We differentiate different exchange rate regimes. We differentiate between fixed and floating exchange rates and something in between that is called a managed float. So do countries fix their exchange rate against other countries? Do they at least try to do so? And we had examples when we don't want to look too far away within the European Union. Before we had the European Monetary Union, there were some price fixings. We are going to talk about this in chapter 14 when we look at central banks and at the development of the European Monetary Union, where we today don't have different currencies but the one currency, the euro. But this works, and what you can read here, governments might fix the exchange rate to another currency, which is typically the US dollar when you look at South America, for example. The other extreme we could say is the normal market as we are used to it, floating exchange rates. That means the exchange rate floats, and we already saw an example for this in the picture above. When there is more demand, then prices go up, which means that the pound appreciates. When there's less demand, prices go down, the pound depreciates, and so on. So this is something that we know, and from as economists, and we in the meantime know some type of economic thinking, is something that we find a good way. We learned at the very beginning of this class that markets are usually a good way to organize economic activity. And that means having open markets is something that normally works well and brings the best results. There's something in between which is called managed floating, sometimes dirty floating. A managed float occurs when the exchange rate floats within a range. Also, this existed in Europe. There was this currency snake where there was a rate defined, but it was possible for the individual currencies to float a bit around this. Let's have a look at these different regimes and start with the regime fixed exchange rate. When we think about fixed exchange rate, again, we might be reminded of our microeconomics classes. Because also in microeconomics, we talked about fixed prices, minimum prices and maximum prices, and the consequences. So when we look here, we see an example for this exchange rate, again, the quantity of pounds. What happens if there is an increased demand, but the exchange rate is fixed? Okay, we have this same shift to the right that we discussed before from quantity demanded 0 to quantity demanded 1. And so with a floating exchange rate, the equilibrium would change from A to B, and the course would change from €1 per pound to €1.20 per pound. That can't happen if the exchange rate is fixed. Now, that is something we saw in microeconomics. Now we have more demand than supply, and we call this a shortage. We called it in microeconomics a shortage also here. In principle, this is a shortage. Now, how can a government fix or try to fix this? It can only do this by supplying an additional amount of pounds in order to keep the price at €1. So basically what they can do is they can try to move QS here from that to there, putting more pound on the market. So how can a government put more pound or more of the own currency on the market? It has to buy other currencies with this. So they can demand euro, they can buy euro. The British Central Bank, the Bank of England, can at the open markets buy euros and pay the euros with pounds. That would increase the amount of pounds available on the market, and that would shift this QS curve to the right until we are again here. Interesting thought experiment, you might think, but it's not a thought experiment. This is what countries who fix their currency, who fix their exchange rates, have to do. The countries, or respectively the central banks of that countries. At the moment, October 2025, just last week, we heard about a big deal between Argentina and the Trump government, that Argentina needed quite a lot of dollars in order to be able to keep their fixed exchange rate, and the US government gave the dollars to Argentina in order to be able to maintain an exchange rate. So why do you want to maintain an exchange rate? Because the exchange rate also means prices, the prices for the imports you buy abroad, and the other way around, the prices for the exports. And if you want to influence this as a government, that's quite an issue, and it might sometimes work for a short period of time. In the medium and in the long term, this leaning against the wind frequently doesn't work because you just don't have enough foreign currency. Foreign currency you would need in the other situation here, reduced demand under fixed exchange rates. And here you can see in order to maintain the fixed rate, the government has to purchase the excess supply of pounds, purchase from the international markets by spending euro. So in this case, the Bank of England has to take its euro reserve and put it on the market buying pounds. And of course, there is only a limited amount of foreign currency normally available in the central banks, which limits sort of the reality of this system. But that's basically the system of fixed exchange rates, and that has consequences. If it's no longer possible to maintain this fixed rate, it says here usually occurs when the fixed rate is continuously supported. So if a country, a central bank doesn't have enough means, doesn't have enough reserves in the foreign currency, they might say, okay, we devaluate our currency, we let the market do this devaluation, or if there is really a fixed rate, then we would announce, okay, the fixed rate is now not 120, but it's 130 or something like this. We have been talking about, by the way, a fixed exchange rate between the euro and the pound, which of course doesn't exist. There's a free floating between these. It's just the example here from the book. And in cases of fixed exchange rates, this is also one danger that can occur, is a speculative attack based on speculation. If traders in international markets expect a country to devaluate, they can buy and sell the currency in order to profit at the moment where the devaluation takes place, which increases the pressure on that currency and might lead to a change in the fixed exchange rate. The other regime is a floating exchange rate, and as we just said, for example, between the British pound and the euro, there is a floating exchange rate, and floating means there are different prices. The prices change over time, and we can in fact see here in a time from 2000, a bit before 2000 to fall of 2025, how the exchange rate, so how many euro in pound have to be paid, how this exchange rate changed. The pound used to be relatively high at the beginning of the century, 160, 170, something like this. Then there were some changes until the financial crisis, 2008, 2009. You can see that it really went down. So it hurt the pound far more than the euro. Would be another story into the history, but Britain is far more in financial markets and so was hit by the crisis especially hard. Then the pound, you could say, recover over some time, and then there is a deep breakdown here. And you might guess or know from history, 2016, that was the date of the referendum where the British people decided to leave the European Union. This was sort of punished, whatever, by the market. It led to far less demand for pound. It led to capital floating out of the country and reduced, you can see here, from around 140 to around 110. And the pound has been there since that time. You can also see here in January 2020, when the Brexit finally became active, became final, there is a movement down, but this was then relatively quickly followed by up and down movements, and the pound has been since then, Britain is no longer a member of the EU, has been in this range between euro 10, euro 20 per pound, and here 16 October 2025, 115, again, observe this to the time you watch this video. So floating exchange rate, they float because they reflect the trade. They reflect whether there is more or less demand on that currency, and that has to do with trade. Which brings us back to the first question that we have already on our board. What is a reason for demand for a currency going up and down? So we are going to discuss this in class. The definition of floating exchange rate: no government intervention. It's a floating system. There is no market intervention by government or central banks. In the long run, Forex, in the long run, foreign exchange markets with floating exchange rates should lead to PPP, purchasing power parity. And you have a definition down here, requires the nominal exchange rate to adjust in order to keep the real exchange rate constant. Another word for this is, or another way of expressing is there is no chance for arbitrage. And arbitrage, again, something we take home with us, read the definition, and let us discuss in class, what does arbitrage mean and which role does it play in our economies, in our economic systems? Which is our second question that we take home sort of officially when we look at what we have been discussing on the Forex market. Number one, what can be possible reasons for a shift of the curve? We might make this a bit smaller. What is arbitrage and which role does it play here? In this context, we often hear about the real exchange rate. Is the exchange rate really reflected, or is this purchasing power parity really reflected by exchange rates? The Economist, the British weekly newspaper analyzing economics around the world, markets and different firms and so on, developed an index which is called the Big Mac index. Our Big Mac index shows how burger prices differ across borders. Now, what does this have to do with purchasing power parity is the first part of our third question about this topic. And once you start researching the Big Mac index, you will find that there is another Mac index proposed. What do you think? Which one is more appropriate? And what are the messages? What do we learn from the Mac indices? With this third question about the Big Mac index, we end our thoughts here about the foreign exchange market or markets. We are going to discuss in class these three questions. Perhaps we do this in our houses group in order to look at different aspects of foreign exchange markets. In the presentation, you'll find two more background slides. One is compares fixed versus fixed versus floating exchange rates. And the last offers some numbers, some figures to our topic. From here, we go on to the second part, which is the balance of payment. Before we look closer at the balance of payments, we have the definition here. It records all transactions between a country and the rest of the world, and we would see different types of transactions. But before we go in details, let us sort of make clear and note as first that the balance of payment is not a balance sheet in the sense that we know it from management, from cost accounting, and so on. Because it measures flows, it measures financial flows. In a balance, we typically measure stock figures, inventory, on a respective reporting date, on one close date. Whereas flow figures we use in a profit and loss statement, in a cash flow analysis, and so on, financial flows measured over a period of time. So normally in a balance sheet, stocks at a due date, and in, let's say, a profit and loss accounting, flows over a time period. What the balance of payment does, it measures flows over a time period. So strictly speaking, the word balance is misleading here. But it is the word that we use, and so let's define it. We see our definition here. It consists of three big accounts. The current account that records goods and services traded with the rest of the world. The capital account records transfer payments with the rest of the world. And the financial account recording purchases and sales of foreign assets. Let's take a somewhat closer look to the different parts here. You can see that it has the two sides, credits and debits. The current account is about goods, services, and transfer payments received, we could say. So exports, when a country exports a good, a car, a washing machine, whatever, or a service, a program, a license, it receives a financial inflow in case of exports, and the other way around with imports. Capital account is borrowings from other countries, there are receipts here, and direct foreign investments by other countries. This means capital flows into our country, whereas the other way around, lending to foreign countries and performing direct foreign investment in other countries is a debit, is a payment that flows out of a country. And then we have the settlement account, foreign official holdings, and on the one hand and on the other hand, that might holdings, might be gold reserves and so on, are the third part that we looked at, the financial account. This balance of payment is supposed to be, or has to be, balanced on the same, we have the same value on both sides. So at the end there has to be a zero, or there has to be the same amount left and right, so that the balance at the end is zero. This frequently doesn't work because it's very hard to measure all the flows into and out of a country. That's why there is quite an errors and omissions part in which you will find the we don't know exactly parts of the balance of payment. And that's already it, the definition of the balance of payment. Let's look at some numbers in order to get a bit of an idea of what we are talking about. Before we come to some applied questions concerning the balance of payments, let us keep this definition that we had in mind, or that we said at the end it will end up at zero. We have the same amounts on the left and the right. That means that exports, for example, so inflows, receipts of money, of financial flows from outside, flowing into the country because of exports, either has to be balanced with imports of goods and services. But now there are countries that typically have a positive current account up here, and these are the exporting countries. This is China, this is Germany, and so on. So obviously there is sort of more money, more financial flows are flowing into the country than go out in the current account, and that has to be reflected somewhere else. Then that means that this money that is available here goes into foreign investment or goes into to other things on the right hand side, so that at the end we come to an equal level. Which means in order to understand what happens here, it makes sense to look at numbers. And so here I again have some questions for you. We'll discuss these questions in class, and we'll also discuss in which way we do this, whether we do it an in-class discussion or whether we make a homework out of it, whatever. You see these questions: which countries typically have a positive or a negative current account? Is there a difference? Sticking to the current account, we are here, exports of goods, services, and transfer payments between these three. Does it make a difference whether we measure in currency, for example, in US dollar, or the percentage of GDP? And then one specific figure for Germany, the current account services. You will find that it has a typical sign, but that changed. 2 consecutive years, 2020 and 2021, the sign was the other way around. So first of all, we have to find out why is the typical service balance of Germany, normally negative or normally positive. You will find out which one of these and why did that change in these 2 years. In order to do that, I assembled figures on the slides. You see it starts on slide 19. That's the current account balance in millions US dollars. The next one does the same in percentage of GDP. We have a comparison between different countries from their balance of payments. We have numbers from the OECD Data Explorer. And by the way, on each slide, you down here have the URL, the link. That is, especially if you do this in following years, if the numbers are a bit older, you can access this and you can reproduce the figures. You can redraw whatever these data wrappers and so on are very good. Here you have the specific question about Germany, about the services. Here a bit more from Germany, from the Deutsche Bundesbank, an overview about the German balance of payments. And at the end, as our book is about the UK and there is this table 11.3 UK balance of payments, there are some more current figures that you also can compare and check whether the figures are still comparable to what we find in the book. The following slides lead us into political questions. The chapter 11.5, real exchange rates and government policy. Here there's a bit of a preparation. What is the balance of payment, or how is the balance of payment influenced by the regimes, by floating and fixed exchange rates? In both cases is what we said, current account plus capital account plus financial account is 0. And if not, we put the we don't know exactly or errors and omissions part in there. So it's 0 at the end. For a floating exchange rate, this should hold. For a fixed exchange rate, there is always the intervention of the government that we explained, the intervention where the government has to either buy or sell the local currency in order to keep this fixed exchange rates. So we have this official financing in here, government intervention in the Forex market. So this chapter 11.5 defines a bit about the real exchange rate. We have been talking about real always has to do something with the price, that we compute the price out of the numbers. The nominal numbers might be inflated or deflated, and if we take the price out, we come to a real exchange rate and measure it like this. And you can see that there are some definitions here. How does fiscal and monetary policy work under fixed exchange rates? That is the description of fiscal and monetary policy was done in chapter 9 as an overview. We said monetary policy is the amount of money in circulation and trying to influence the interest rate by the central bank, whereas fiscal policy is what the government does with spending money, but also getting the money via taxation and so on. And under fixed exchange rates, you can do a lot with fiscal policy, but monetary policy doesn't have a huge influence, where then it's the other way around. Under floating exchange rates, monetary policy is relatively powerful. This is something we can think about when we think about from our point of view as in countries, at least most of us, looking from Germany, looking from a European perspective, where we have a floating exchange rate. That means that monetary policy can lead to larger impacts and that it's not easy to do fiscal policy, to do intervention in markets via fiscal policy. That's something we are going to look closer in chapters 13 and 14. What is fiscal, what is monetary policy, and then bringing this in the international context. Which leads us to the last part of this chapter 11, the European Monetary Union. You might recall that at the start we said our British authors, asked this question, would it be better for Britain to become a member of currency zone of the European Monetary Union? This European Monetary Union is what we call the Eurozone, are these countries that together have the euro as a currency, and with this, of course, do not have any exchange rates in between the countries. In fact, we're not going to dig deeper into details here, as we are going to do this in chapter 14. Just as an outlook and in the context of this original question, should Britain join the monetary union, which is today a purely theoretical question, as Britain is not a member of the EU and so cannot be a member of the EMU. But anyhow, there are some, this is the picture that will reappear in chapter 14. There's a bit of an overview about the European Monetary Union, which countries belong to the EU, to the EMU, some numbers about this. The Maastricht criteria, the criteria that were set up by the then member states to be of the European, or of the member states of the European Union and the member states to be of the European Monetary Union, something we should keep in mind because they are today known as the stability criteria within the Eurozone. Our book thinks about what are optimal currency zones, and on this basis discusses the advantages and disadvantages of Britain, of the UK, becoming a member of the Eurozone. Positive criteria, what are the different effects here, potential costs, lost trade, and so on, and together with the question, is it an opportunity or is it a threat? This question generally we are also going to pick up in class, given that we now discussed the theory of foreign exchange markets and what this has to do with the balance of payments and generally how we measure this relation between the different countries. We are going to use this application of the British, the British question in direction of entering the European Union. So much for the theoretical input in our chapter 11. There's a bit of a summary. Here you should be able to explain these different aspects here. And I'm looking forward to discussing these with you in class and to applying the theory that we have been hearing about here, that we have been reading, to the real world, to the things that are important at the moment in the current political situation and are important for you as management students and future managers. See you in class. Have a nice time.